Hello and welcome to the paid weekly recap for the week ending September 9th, 2025. I am Keith Harwood, CIO of Yellow Tunnel, also pictured as Vlad Karpel, the CEO and founder of Yellow Tunnel, and the creator of the artificial intelligence behind the paid system. Before we get started, normal disclosures: options involve substantial risk and are not suitable for all investors. Yellow Tunnel and myself are not investment advisors and not registered with the SEC nor FINRA. The information in this presentation is for education and information purposes only and should not be considered trade advice. And finally, myself and or the team at Yellow Tunnel may have a financial interest in the securities presented and the trade ideas. If you need a few more moments with the disclosures, please go ahead and pause the video here. Otherwise, we will get into the recap for last week. So first things first, we have the 10-year yield. The Fed met. We were testing the 4% level, looking for a potential breakdown here to retest potentially the market low interest rate that we were seeing back in April. Now, of course, this was with the market at significantly lower levels. Now we've got the market in a bull mode. And when the Fed met, Fed made their announcement, the commentary created a little bit of chop in the market before ultimately starting to send interest rates a bit higher. The new range seems to be settled in at about 4% to 4.2%. We will see if that holds for the coming time period. Prior, we had seen ranges like 4.2 up to 4.35 or all the way up to 4.5. If we start seeing levels closer to 4.6%, certainly inflation becomes a concern, but right now we're at a much lower level and inflation doesn't seem to be a major concern. And the market is taking it in stride. The S&P 500 initially looked like it may try to break after the Fed announcement on Wednesday, but then we started going back higher. We made a new high on Thursday, closed very close to the all-time highs on Friday, and the market bull case is developing much more aggressively. Now, we do have an RSI above 70, so the RSI is showing overbought conditions, but at the end of the day, we are starting to get a bit steeper bull trend going with the 10-day moving average now providing support instead of the 20-day or maybe even 50-day prior to this point. We continue to see higher highs and higher lows. Ultimately, this is a bull market that is shifting away from maybe the dip buying opportunity and more towards just buying and holding. Prior, dip buying made sense because every time we started to rally, it was pretty shallow rally followed by a big dip that allowed for a better entry. And the distance between the dip and the next high was a much more meaningful return than the prior high to the new high. So timing the market definitely made sense. We may now be shifting into a spot where just buying the market and accepting the fact that we look like we want to go higher makes a lot of sense. Now, anytime we see a new fundamental input, such as non-farm payrolls in a couple of weeks, all of this can change. But for now, this market looks ready to go into bull territory. And in particular, we're seeing that out of tech. Tech has now a 74 RSI, or just about, a little bit higher than the broad S&P 500. Growth and risk seems to be the desire for this market. Again, the 10-day moving average is the new support level. We're at the upper Bollinger. We're at our overbought RSI. We may see a dip, or we may just see a little bit of consolidation to allow time to catch up to price. In other words, we may stay here. We don't have to go lower for the overbought condition to be resolved. We may also explode higher. That does happen in these sort of markets. But overall, again, seeing a bull trend forming, continuing, new all-time high for tech on Friday. And last, we have small caps. Now, small caps initially had the most bullish reaction to the Fed and then pulled back on big volume. That looked concerning by Wednesday afternoon, but then on Thursday, we started to go higher again, made a new high for the last 6 months, made a new high again on Friday, and actually got to a new all-time high by the end of the week before dipping back down to a little bit lower levels. Small caps continue to lag, but it is in a bull trend, and it is a much more established bull trend in many ways over the last few weeks, even though it's been very choppy. Traditionally, we've been seeing spike up, then a 4 or 5 day pullback, spike up, 4 or 5 day consolidation period, a little bit of a spike up, 4 or 5 day consolidation period. We had a spike up on Thursday. May see a few days of consolidation, but overall, we are seeing the stair step higher for the small cap section of this market. And finally, the VIX. The VIX is at 15.5. That's too high if this bull market is going into effect. The VIX should be making new lows, sub 14%. So there is still some desire for hedge and or some lack of desire to sell calls into this market rally. Traditionally, when we see a bull market that is going slow and steady, we see sellers of calls to finance the purchase of puts for protection. So far, it seems more of the action has been focused on buying the put for protection rather than financing it by selling calls. So for now, the VIX is staying at 15.5%, not going to new lows. Perhaps that will change this week. And as that leverage is still on a generally low level, maybe not the ultimate lowest level we've seen for 6 months, it does still provide some great leverage and defined risk via options in the paid system. Now, speaking of the leverage side, we had the Google trade held over from the prior week, and Monday it exploded. Monday was a big takeoff for Alphabet. That turned what ended up being a 7.5% profit in the stock into 146% profit in the options. Nice holdover for the weekend for Google traders. Great return. Overall, nothing to complain about there by any means. Secondarily, we had EWT, Taiwan. Now, EWT is actually heavily concentrated in TSM, Taiwan Semiconductors. TSM and EWT consolidated this week. So it was a low risk position going into the Fed, low reward potential going into the Fed, with a possibility of some spike, but it didn't occur this week. So overall, that low risk ended up with the stock, even though it went up about 0.7%, the options ended up down about 12% for the week. So a small loss on the options, relatively speaking, small profit in the stock, relatively speaking. We do have some theta issues as well as some crossing of market issues that cause sometimes a small loss, even when the stock can post a small gain. Now, this upcoming week, we are looking at 3 new positions. Nice liquid positions, ones that may generate some nice returns. Hopefully we see something like we saw in Alphabet the prior week. But if not, we'll have that risk defined and we'll see how things go. We also have the live trading room, so make sure you're joining us on that. That goes from 9:15 to 10:15, 10:30 Eastern time in the morning, and from 3 to 4 Eastern time in the afternoon. We talk through all sorts of market conditions, all sorts of trade ideas, AI-generated signals, as well as anything that you'd like to discuss. So please join us if you have questions or comments or stocks you'd like us to evaluate. Vlad and I are always happy to answer questions. And if you need to reach out to us via email instead, we're always available. Keith@yellowtunnel.com and Vlad@yellowtunnel.com. Looking forward to another great week in this market. And we will be talking to you on Tuesday morning with some new trade ideas. Thanks again, everyone.